Flexi Cap mutual funds are the flavor of the season, with every second newspaper talking about why you should invest in them, and even a lot of the fund houses pushing their Flexi Cap funds as the choice of investment in the current market condition. To understand whether a Flexi Cap mutual fund is the right investment for you, watch this video all the way till the end. What exactly is a Flexi Cap mutual fund? A Flexi Cap mutual fund is one which can invest in stocks across the market capitalizations. That means a Flexi Cap fund can invest in either a large cap stock or in a mid cap stock or a small cap stock, and the proportion of investment that it can hold in each of these three categories of capitalization, there have been no limit set to it. So there is no minimum amount that has to be there in a certain market capitalization, or neither there is a cap on the maximum amount that a manager can hold when he is managing a Flexi Cap fund. Converse this with a large cap fund. When you put your money or give your money to a mutual fund which is a large cap fund, the major portion of the investments for the large cap fund have to be only in large cap stocks. A large cap fund cannot be holding a large portion of small or mid cap stocks, because by its nature it has to be a large cap stock. So irrespective of how large caps are doing in the market, it has to hold a major portion of its investment in large cap stocks, versus a Flexi Cap mutual fund can rotate its investments among large cap, mid cap and small cap stocks depending on which particular kind of stocks are doing well and in what market conditions they're doing well. The major reason for investing in a Flexi Cap mutual fund is that there is no market capitalization category of stocks that do well in all market cycles. What do I mean by this? If you look at the performance of the three categories of stocks, that is your large cap, small cap and mid cap stocks, over the last decade, you will find that in certain periods, it is the large cap stocks that are doing well. In certain periods, it is the mid cap stocks that were doing the best, say like in 2017. And in certain periods, the small cap ones have outperformed if you look at the performance in 2021. Similarly, when markets fell in 2018, large cap stocks did not fall much, but the small and mid cap stocks were hammered majorly when the markets corrected in the year 2018. So what you can see here is that no category of stocks in terms of their capitalization do well in our market cycle. In different market cycles, different kind of stocks are doing well. And a Flexi Cap mutual fund gives the fund manager the ability to move into those stocks which he expects to do well. If a fund manager was heavy on small cap stocks in the last 1 year, he would have performed the best compared to a fund manager who was heavy on large cap stocks, because the small cap stocks have outperformed the large caps by a large margin. Now, obviously, with this flexibility comes a lot of risk and responsibility. You should be able to vet that the fund manager is good at taking a call as to whether in the future period a large cap stock is going to do well, or is it the mid cap or a small cap stock that is going to do well. Because if he is able to get his call right, then he will be able to amplify the returns that you expect when you invest in a Flexi Cap fund. But if the fund manager gets his call wrong, then you may actually land up by sitting with a fund where the fund manager is invested in a large cap stock in a period when small caps are doing well, and he is holding small cap stocks in a period when large caps are doing well. To show you a couple of funds with a live example, let's look at the portfolio of an SBI Flexi Cap fund and a Tata Flexi Cap fund. In the month of March 2021, SBI Flexi Cap fund had an exposure of 67% to large cap stocks, 16% to mid cap stocks and 10% to small cap stocks. If you look at a fund in the same category, Tata Flexi Cap fund had an exposure of 77% to large cap stocks, 20% to mid cap and 3% to small cap stocks. So you can see here that in March 2021, Tata Flexi Cap was overweight on large cap stocks compared to SBI Flexi Cap fund. Now what happens 9 months down the line when we come down to December 2021, the portfolio looks a little different here. SBI Flexi Cap fund has reduced its weightage in large cap stocks from 67 to 62%, and their exposure to mid-cap stocks remains same at 16%, and they've increased their exposure to small-cap stocks from 10 to 13%, and they've also added a certain exposure to foreign stocks. Whereas when you look at Tata Flexi Cap Fund, they have reduced their exposure in large cap funds from 77 to 69%, for mid-cap stocks from 20 to 17%, and the reduce in large cap and mid-cap stocks has been offset by a large increase in small cap stocks from just 3% in March 2021 to 14% in December 2021. So we can see here that over this period of 9 months, the outlook of the fund manager of SBI Flexi Cap Fund is different from the outlook of the fund manager of Tata Flexi Cap Fund in terms of their change in weightage, wherein the fund manager of Tata Flexi Cap Fund is getting a little more bullish on small cap stocks compared to what he was 9 months back. Now, who will be right? That is something which time will tell. But that's a double-edged sword when you put your money in a flexi cap, that if the fund manager gets his call right, you will be able to amplify your investments. Whereas if the fund manager is wrong, you may actually land up losing your money when you're invested in a flexi cap. It's like when you decide to have Chinese food, what do? Do you walk into a Chinese specialist restaurant, or do you get into a multi-cuisine restaurant that also offers you options of North Indian and South Indian, and once you sit in the restaurant, maybe your mood changes, or you think that the multi-cuisine guy will still end up serving you Chinese, which is better than the Chinese specialist restaurant down the street, right? So if you walk into a multi-cuisine for eating Chinese food, you may be disappointed because he may be good at serving you North Indian food or South Indian food, but may not be good at serving you Chinese food. That's exactly what happens when you look at a Flexi Cap Fund. If the fund manager gets his call right, you are going to definitely amplify your returns. But if he gets his call wrong, then you're going to land up with losses in a time period when equities as a general are doing well, but your fund is not doing that well because you're sitting with the wrong set of market capitalization stocks. So when you look at whether or not you must own a Flexi Cap Fund in your portfolio, first decide what does your portfolio consist of. If you are very clear that you want a certain amount of exposure to large cap, small cap and mid cap stocks, why not go ahead and buy those particular funds which specialize in those particular stocks? And you know exactly that 60% of your portfolio is going to be in large cap stocks, maybe 30% in mid cap and 10 in small cap. You can control that by holding those funds which invest only in these kind of stocks in that proportion. Second, how confident are you about the ability of the fund manager to do well across different market cycles? When you design the portfolio for yourself, if you are very clear the kind of exposure you want to large cap stocks, mid cap and small cap stocks, you can hold them via the respective mutual funds who invest in those stocks. Versus if you think that the fund manager has the ability to rotate the money across these capitalizations and be in the right kind of capitalization at the right time, you will be able to amplify your return. So you will want to take a Flexi Cap Fund when the market conditions are such that it will help to move across different market capitalizations, and you believe that the fund manager will be able to take the right call on your behalf. Another thing you must keep in mind is that if you are a risk averse investor and you are happier staying in the large cap space or maybe a small exposure to mid cap space, a Flexi Cap Fund has the ability or can go heavy on a small cap stock or small cap set of stocks and result in actually a Flexi Cap Fund, which is, if the fund manager thinks it is good to be in small cap, he can be a heavy weightage into small and mid cap stocks, resulting in a higher exposure or higher risk for you as an investor. So if you are ready to take that exposure, that is the second reason when you can think of getting into a Flexi Cap stock. But if you are somebody who does not want any exposure to the smaller cap stocks or mid cap stocks, then you want to avoid a Flexi Cap Fund completely. Just like when you walk out of the house on the weekend, if you made up your mind on what you want to eat, whether it's Chinese or something else, you decide your restaurant accordingly. Similarly, plan your portfolio well, know exactly the kind of funds you have in your portfolio, and if you decide to add a Flexi Cap Fund, know why you're adding the portfolio to your fund, and also know that the fund manager has shown in the past his ability to rotate the stocks among these capitalizations in a way that it turns out to be beneficial for you. So the next time your friend shows you an ad on the fact that you should get into a Flexi Cap fund, share this video with him so that he will know whether it is the right investment for him. And do like, share and subscribe our channel for freshly brewed content on every Wednesday and Saturday.